Hey, welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable, all produce high free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate cash flow. Company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks are taking the show, but our mid cap stocks are going to come back. Chinese stocks are exploding. Dragon has awakened in China. It could be the best trade we've seen in a while. It's really interesting. AI is going to be interesting in the future. But is it really a business today? I'm going to pass on this stock. Just not enough discount. And I'm not really believing that they're going to grow. Options can make your performance go a little higher every month. Generate nice. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their video. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock. Unappreciated. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor, and you will build great wealth. All right, everybody. Good evening. Hopefully everybody's having a very good Wednesday. We've had an interesting beginning to October. We had a phenomenal September. It was a little bit unexpected. I was expecting that the month of September was going to be down, but it ended up being a real positive month for me. I did my performance review and the month was great. So thank you, stock market. I'm glad I bought all those good stocks, all those good companies, and they went up in value in the month of September. Now getting out of the gate for the month of October, it's we're kind of getting out to a slow start. Not the biggest problem in the world. I think we've got plenty of days to catch up, but we've got some things to worry about, right? We got this big election coming. We are sitting on an expensive stock market in the United States, which made the splash that the China stock market is making that much more attractive. And I would say the timing's pretty good for a new trade to enter the picture, right? China could be a really, really good thing going forward. Looking at the next 2 years, I mean, if we look at fundamentals, which I can look at, I'll look at a couple of Chinese stocks in our stream today to kind of show you what I'm seeing. Thanks so much for everybody who's on so far. Looks like I've seen some old friends, and I haven't seen you guys because I haven't been streaming in the afternoons, evenings. So it's nice to be back streaming probably for the West Coasters and maybe people in the Mountain Standard Time Zone. So good to see you, retired guy. I'll take a look at CTVA in our stream. Bad Omen, cool handle. Good to see you again, man. It's been a little while, and we can look at J&J and take a look at Rivian. Glad to look at Rivian. Rivian's really interesting. We'll take a look at that. I might even start with Rivian because I think the company's pretty interesting. Before I jump into analyzing, I wanted to see if you guys can consider becoming a paid member. It doesn't take a whole lot of money, but I'd really appreciate that. You get some perks if you're a paid member. When I stream, your name gets highlighted in a particular way, so I can really jump to members and try to get to their questions and the stocks that they're looking for, as well as you get a tool set access through a shared folder for members only, so you can use some of the same tools that you're going to see me use today. And we're going to have a member-only conference call each week. So please consider it. It's on the details of the stream, and I appreciate it. Hey, Brad, good evening. Very good to have you. Thanks for joining. Let me turn off this banner, and then we'll get going. All right, so let's talk a little Rivian. So those who don't know Rivian, Rivian is a EV company, and what makes them a little different is that not only are they a consumer car company, but they really had the idea of creating electric vans for predominantly Amazon. And man, I'm in Southern California. I see those Amazon vans everywhere made by Rivian. And I think that's really going to help them get a very stable business off the ground. They've got this giant customer. I believe Amazon owns part of Rivian. So they are really using a lot of these electric vans, which is a great idea to keep down the emissions and the noise as well, because they're quieter. And maybe they'll save some money. Go Amazon. So let's take a look. So Rivian is a $10 billion company, but you know what's incredible? Let's go back. And what's the symbol again? So Rivian is RIVN. Rivian at one time was the world's second most valuable company, and they had shipped like 50 units, like 50. I think they had shipped 50 of their trucks. They hadn't even released their vans yet, which is kind of ridiculous, don't you think? So they IPO'd, and they were way up here, $129 per share, and now they're at $10 per share. So I'm not a big IPO buyer. This is the reason for it. This is a quality, what I think is a quality business with a good idea. But man, a lot of IPOs, they drop, and then at some point you can buy into the stock once you get better data. Some financials are out there, some really good data to make a decision on it. Because back then, holy smokes, they sold into a very high stock market in 2021. We were flying high, and Rivian came out. When they came out, they were the second most valuable company in the world, and they had shipped like 50 units. Just nuts. They were more expensive than like Toyota that was shipping out millions of cars. So I thought that was interesting. All right, so getting into Rivian, let's try to take a look at it and say, is this a good investment? Now, my criteria, right? I'm a long-term investor. I like to look at a business qualitatively and then look at it quantitatively. Qualitatively, is it a good player in an industry that I like? Do they have competitive advantages? Are they a top performing company within their industry? So I'll go there, and then we'll go into fundamentals. So I think Rivian has a good business plan, especially around those vans, because those vans immediately make it more of an industrial stock versus it being just another car company, right? Because there's a lot of car companies. The competition's tough to make, sedans, SUVs, and trucks. That's tough. You're competing against companies that have been around for 100 years, and trying to compete against those companies is really tough. This company is trying to do it a little bit different. I think they're still going to have a lot of headwinds. I'm not in love with their industry. I don't like car companies. I think they don't make enough money. Their margins are not as great as, let's say, a software company or a Google or an Apple, companies like that, technology companies. nonetheless, let's take a look. So it's a $10 billion market cap company, 10.7. They're already a $5 billion revenue company. Okay, so 2 times the revenue. They're not profitable yet, or we'd be seeing PEs. They're saying, analysts are saying it's a buy and it's discounted quite a bit. It's probably because in the 1 year it's down 56%. So what's going on? When I look at a company like this, it's young. It's important to look at it from the annual, financial statements, but also for, and I bet you the sound was pretty terrible for the first couple of sessions. And for the company, I want to look at the annual, revenue, but I also want to look at quarterly. Quarterly is really important because quarterly is going to tell us more about what their most recent growth rates are looking like. The last quarter really tells me a lot because this company's so young, things are changing very quickly. So I'm going to look at annual and then I'm looking at quarterly. Okay, so the annual, we've got revenue's been growing 68%. If we look at trailing 12 months, that's a very good growth rate. Okay. And if we look at the quarterly, growth has slowed down. See how dramatically it's slowed down? Went from 82 to 3.3. That is not good, right? If you compare Q2, you're comparing it to Q2 of 2023, and they just barely grew a little bit, which isn't good. That means what's going on? Are they not able to sell as many of their vehicles? Do their customers not like their products? So that is that's a red flag. So one red flag. Okay, so back to profitability. Gross profit, see, they lose money. They can't even be profitable by putting their prime costs into the vehicles and sell them. They're not profitable at that level. So that is a second red flag. 2 red flags. Okay, so that's that. Let's take a look at how much cash they have. That's going to be really important. They have $7.8 billion. That's going to be really important because they need that cash. They're going to be burning cash for a while. And how much debt do they have? Total debt, $6.1 billion. Okay. So they have about $1.7 billion of net cash, but they have that debt, which will give them some time. When we look at cash flows, they don't do any cash flow from operations. And then they spend money on the business. So these guys, man, I don't see when they're going to be cash positive. They're going to run out of cash. They're going to have to issue out more stock, or they're going to have to get more loans. So their balance sheet is going to go from being net zero debt because they have more cash than debt to eventually having some debt on it. I'm already backing off from the stock. I don't like it. I don't like the growth in the most recent quarter. This would be very concerning to me. Like, they're not growing, and they're only $1 billion for that quarter, right? The car business is huge, right? If you look at big companies like Toyota, they're massive. So this one here would be a pass for me. And again, I don't like car companies, too much competition, not profitable enough. And this one here, I don't see how they're going to make it to profitability in the next couple of years. And they may be an acquisition. One of the bigger companies may acquire them for their assets and, because their stock price is so low, and then take them over. Now, if it's an acquisition, it could be a payoff for stockholders, but that's not the only reason I would buy the stock. I wouldn't make that the principal reason why I'm buying the stock. It has to be fundamentally a good investment. And I'm not seeing it. It's not the right industry for me, and they're not making any money. So those are my comments on Rivian. Thanks for asking about it. Sergio, how are you? Looks like you're saying good night in Portugal. Hope you're doing well. Everyday Tech, thanks for joining. Micron. So let's take a look at Micron. Shadow Guy. Hey, Shadow Guy, I appreciate you joining. I know it's a little late for you, so I appreciate it. So I wonder if Rivian will be a Tesla proxy. Maybe. Tesla's got, I think, their set of challenges. Mainly, it's just so much competition in EVs. And the biggest, I think, competitor that is going to come around is China. China's got EVs. They make good EVs. They're a very good manufacturing country. And I think they're going to be a formidable competitor for all these car companies. So we'll see how they handle China. All right, so let's move on to CTVA. Not familiar with CTVA. So CTVA is Corteva. So Corteva operates in the agriculture business. It operates through two segments, seed and crop protection. The seed segment develops, supplies advanced germ plasm and trades to produce optimum yield for farms. It offers trait technologies to enhance resistance to weather, disease, insects, herbicides. So this is kind of like a science company that's helping farmers with better seeds and a better ability to plant crops that are gonna resist maybe a little bit of drought, maybe some pests that would come around. So this is a lot like another business that I'm thinking is, I forgot the name, but I'll think of it later. So the market cap of the company is 40 billion. All right. So this is, what's the sector that they're a part of? So they are agricultural inputs within the materials sector. Okay. Now farming tends to be stable. So they're a roughly 17 billion revenue company, 41 billion in market cap. They are profitable. PE is really high at 47, but it's going to come down to 19 in 2025. It's a buy according to the analyst, and its price target is about 5% higher. So it's being discounted by 5%. When we look at the 1-year chart, this stock has been working 14.69. You get that 1% dividend. So it's been okay. Over the 5-year, it's been a very good stock. It's doubled in value. That looks good. Let's take a look at their revenue growth. Now, revenue looked good in 2020, 2021, 22, but in 2023, they went flat and actually lost a little bit of revenue, 1.31%. In the trailing 12 months, gotten worse. We look at the quarterly. Q1 revenue dropped quite a bit. It dropped 8%, but it looks like they're beginning to grow again. We compare Q2. Okay, there's been kind of a headwind here. And I'm trying to think, why would they have a headwind? Like, it's not like farmers are not planting. That'd be interesting to figure out. So I'm going to noodle on that. Right now, it looks like the business is beginning to grow a little bit. Let's take a look at their profitability and go from there. So gross profit looks okay. Gross profit's about, I'm going to say about, they've got 45% gross profit margins. Yeah, that's okay. It's not like tech, but it's better than automotive. Looking at their balance sheet, we got cash and short term, which is about $2 billion. We want that total debt not to be too high, 4.7 billion. So about $3 billion of net debt. And if we look at their EBITDA, we want them to be able to pay off all their debt in less than 3 years. EBITDA is 2 billion. So yeah, they can pay it in less than 3 years easily. So good balance sheet. So when we look at their cash flows, cash flow is the number one metric that investors look at to value a company. So we will look at free cash flow. They're at 1.5 billion. They have been cash flowing, not consistently, but cash flow has been there. So 1.5 billion. They're not growing, which is kind of a buzzkill for me. The best I can do is like maybe 25 to $30 billion in market cap, and they're above that at 40 billion. So this is a steady stock. It looks like the stock has really worked for the last 5 years, but I'm just not seeing how this could be overly exciting for me because they're generating $1.5 billion of free cash. If I multiply that times 20, I get to 30. A growing business, I would multiply free cash flow times 20. That would get me kind of in the ballpark. And that would be a decision. Do I want to do further analysis and really invest more of my time? But at this point, the answer is no. We're not even close to their market cap. I've seen that in the last 5 years, the stock has really run up. Is it potentially going to come down from there? Potentially. It could be. I think all the good news is priced into the stock. And I'm not looking for stocks that are just going to break even. I'm looking for a stock that's really going to appreciate in value. So that's my story on Corteva. I appreciate you bringing it up. I don't think I've ever looked at that stock. And let's move on to J&J. Let me catch up on some. Trader Pratt is with us, and he's going to start his stream, I think, in roughly an hour. So he does trading, and we've had a lot of volatility first 2 days of October. So he's got a lot of interesting things to say. And the hat here is from the university that I got my undergraduate degree in, Long Beach State. This is the baseball team. We have a good baseball program. We don't have a football program, but that's where it's from. And Shadow Guy knows what he's talking about. Long Beach. Nice. Good night, Shadow Guy. Thanks for attending. Brandon V, you want to talk about, I think it's Celsius, right? Yeah, we can talk about Celsius. All right, let's keep rolling. J&J is a healthcare company, and they are one of those stocks that was super stable, but they dealt with some lawsuits. They had talc that was proven to cause some conditions in people, and they were dealt with a class action lawsuit. So they had to deal with that. That was a biggie. But other than that, the business is pretty steady Eddie. We'll take a look at the revenue growth and so forth. Now, this is a very trusted business, and you're paying for it. You're paying $88 billion in market cap. The revenue is $86 billion. So it's a big company. Their PE is nice at 10.4, and then in 2025, it's going to be 16.2. It's a buy according to analysts. It's got a small discount. When we look at their revenue, they have been growing. Very good. Very, very good. Looking at the quarterly, that looks good. This is a big company. So for them to grow 5%, that's pretty good. That's pretty good. You saw their revenue, 80 some odd billion. 5% is like $4 or $5 billion of revenue. We saw Rivian, they were cranking out $4 billion in revenue for the whole company for the whole year. These guys grow by that amount each year. Healthcare tends to be a good profitable industry. When we look at, see this gross profit, 60 billion, right? That's a very good profit margin. If we're looking at that, that's at least about 70% profit margin. Those are the businesses that get valued higher. That's why our friends at J&J are rolling around with close to $400 billion in market cap. Healthcare companies, pharmaceutical companies specifically like Eli Lilly, Johnson & Johnson, that create a drug, they have to invest in the drug discovery process. But once they have drugs that have been proven to help people, the manufacturing cost of those drugs is very, very inexpensive, but they get a very good price because they have to recapture the investment in all the drug discovery. Having said that, Johnson & Johnson has a very good portfolio of products where they're able to grow their revenues very profitably. So that's why they're worth so much money, is that profit. The balance sheet's probably in good shape. And the reason I'm going to guess at that is I own a Johnson & Johnson bond, and they have one of the best ratings you can have as a corporation. So I know that they have a very high debt rating, which means that their balance sheet's probably really good. So they're a $25.4 billion cash carrying company. That's pretty good. That's pretty good. And total debt is 41. So net debt, they're at like $17 billion. And I bet you their EBITDA is going to be huge. So when we look at their EBITDA, EBITDA is 31 billion. So they can pay for debt. Like if they focused on it, pay it in 6 to 8 months, boom, no more debt. So these guys are very good business, sound business, quality profitability, very good balance sheet. So you're seeing a lot of green flags. No wonder they're worth almost 400 billion. That's why they're worth so much money. Now let's look at their cash flow. And this is where, this is why the stock market says, when you generate cash flow, we will value you at a very high rate. We'll use my factor, right? This is a growing business, quality business. We'll take their $20 billion of free cash flow over the trailing 12 months times 20. That's 400. $400 billion value cap is what I believe this company is worth. High level, ballpark figure. And guess what their market cap is? 400 billion. So they're fairly priced. Johnson & Johnson rarely surprises investors, other than that big class action lawsuit that they dealt with, that investors kind of rode the pain train over that one, because the stock, as you can see over the last 5 years, it's had its moments. Right now, it's riding a pretty nice stock price. But this stock will work if you want to pick prices and kind of buy a quality stock when it's discounted, because you can see with this volatility, it offers discounts at certain times. Now, I have a bigger bet than Johnson & Johnson in their industry that I would rather be in, and that bigger bet is Pfizer. Pfizer, I believe, is misunderstood, and this is being recorded. In a year, I'm willing to bet this is going to be worth a lot more, and I'm willing to bet that my stock's going to be worth more than twice its current value in the next 5 years. Again, this is being recorded. We can come back in a year and see how far off I was. And I'm willing to admit when I was wrong, but that's how I feel about Pfizer. Why do I feel that way? Well, first, this is historically very respected, not as respected as Johnson & Johnson. Johnson & Johnson, got to tip my hat to them. They've been like a class act company, but Pfizer's been really good too. These guys do more like drug discovery, and they nailed COVID, of course. And after COVID, the market just sold these guys off. Just, you guys are worthless, and just sold them off just severely. And that's where the opportunity started for me. So I started accumulating shares. Their revenue isn't bad, 55 billion. You have a better revenue ratio than Johnson & Johnson. Look at the forward PE, 11. Ridiculous. And this company is beginning to grow. You see this red? That's because they came out with a vaccine for COVID. They went from being a $41 billion company to $100 billion in 2 years. They just shot out of a cannon because they had the COVID vaccine. They made lots of money, lots of cash. They acquired another business for $5 billion, and they paid cash. That's when you know you're legit, is when you can pay cash like that for an acquisition. And that new acquisition is already, they've monetized the drug therapies they have, and that's going to add to their revenue. Now, one thing I'll point is 55 billion is a lot higher than 41 billion. So you see that the company has organically gotten bigger as a company. We look at quarterly, they're beginning to grow. This was what was missing, and this is what the market disliked. Is why are you losing so much revenue? Because COVID is gone. We can't sell vaccines if you don't have COVID. You can't do it. So, all right, we got to get that out of the system. And once we start getting compares to non-COVID vaccine quarters, you're going to see this growth. And I believe this growth is going to start getting into the teens. Once it gets into the teens, this stock's going to start to work. Now, the balance sheet's in good shape. They got lots of cash, $7 billion, and they have some long-term investments, I believe. Long-term investments. So they have so much cash, they got to put it into long-term investments so they can earn a better yield. So they have about $18 billion of cash and long-term investments. I'll show you their income statement a bit, and you can see their interest that they earn. Now, when we look at debt, they have 69 billion and 70 billion in debt. You decrement that 17, 18 billion, and then we compare it to their EBITDA, which is 10 billion. So right now they're operating at about 3.5 debt to EBITDA. And I think this EBITDA is lower because the past year they took a bunch of write-offs. So they were one-time income statement items, and it caused them to be unprofitable. Those were all, in my mind, all like paper losses. They weren't actual losses. So I'm fine with that. When we look at their interest, I think they break even. Interest income, interest expense is about the same. So nothing big to show there. So this is one of my bets that, hey, within healthcare, I'd like to see this stock more than double in the next 5 years. And that's why I bought it. J&J doesn't float my boat because I think J&J over 5 years, I might do, I don't know, 40, 50% return collectively. And that's great. That's great. But when I look at a stock, I'm looking at, I want a great return. If I want an okay return, I'll go buy some bonds. I owned real estate. Real estate's great because it compounds, but real estate kind of grows slowly. The good news is it just keeps growing, and it keeps growing and growing, which is great. Now, I want Pfizer to more than double, and I cannot be confident in saying over the next 5 years, this stock, is it going to double? Well, it's done 24% in the last 5 years. When we look at Pfizer, it did double in the last 5 years. The only problem is it more than doubles. It's $35 a share, went up to $60 a share. So it didn't quite double, but it almost doubled very quickly in 2 years. And then it dropped back down and dropped lower than it was before. How is that possible? They generated all this cash, put it on their balance sheet, became bigger, and now they're less valuable. That's kind of nuts. So we'll see where this stock goes, but this is one of the stocks that I continue to believe in. I almost, I started to doubt Alibaba because I felt like Alibaba was a really good business. Just nobody wanted to buy China stocks. Nobody for the last 3 years. It was like, just throw your China stocks away. And it's like, man, so I just hung in there and the payoff came, right? 2 weeks ago, week and a half ago, when the Chinese government started supporting their own companies, boom, took off. So it looks like, Brad, you've been dollar cost averaging into Pfizer. Man, I hope soon we start seeing some positive results there. When is their earnings? October 29th. Trick or treat, 2 days early. Hopefully they give me a nice treat 2 days before Halloween. And I'm going to be the 29th, I'm sure, is a business day. So they announced before the market opens, I'm sure I'll be doing a live stream so I could talk about it then. And I'll do a video immediately because this is one where, I'm a student of the game and I love trying to figure out companies. I love finding companies where the market doesn't understand them and it sells them off like, oh, this is terrible. This is invaluable. And then you pick them up at the right time. You see them go up. A recent win was Zim. Another recent win, Starbucks. Both I sold. I had both stocks. Like Zim, I held for 6 to 8 months. I walked away with a 50% profit. So if you annualize that, I made more like 80 to 90% return because it was only for like 6 to 8 months. And I dollar cost average. So it's even lower. So it's even a better return. And our friends at Starbucks, now I got to admit, I was a little lucky on that one. When they hired that new CEO, the stock just flew up. But I really did believe in the business. I think the market really recognized that, hey, that's a really valuable business. And with the right CEO, it should be worth a lot more. So I wanted to shrink my portfolio, get more cash. And this is all before China stocks started to rock the world. And I sold $32,000, $34,000 of Starbucks. Walked away with a really nice profit of 32, 34%. I held the stock less than 4 months, and that is a nice return. So when I figure out companies that are like misunderstood, buy them at the right time, bingo, and they reward me, it's just really fun, man. It's super fun. And I think Pfizer is going to be one of those stories. If not, it's going to break my heart. We'll see. We'll see. All right. So we went over Pfizer. Let's keep rolling here. We went over J&J. Now we're going to talk about Micron. Micron has had a very nice week. They had a good earnings report. Their business, when you look at their financials, it's like, wow, man, it's almost like you're looking at two different businesses. It's like a Dr. Jekyll and Mr. Hyde kind of situation. The market cap of the company is 110 billion. Revenue is 25 billion. So you're paying a little more than 4 times revenue. And forward PE is just 11. This is a semiconductor company and very little dividend, strong buy, 46% discount. This is where this stock is. When I look at I say this, right? Semiconductors are cyclical. They have a couple good years, a bad year, maybe a 3-4 good year run, a couple bad years. And it's just their semiconductors get consumed. They get put into operation. And then the customers don't need much more. And for some reason, customers did not need much in 2023 for their fiscal year. And their revenues just dove off a cliff. It's like, what happened here? 2021, they were growing at a nice clip, but even though 2020 was a bad year. So they were growing nicely in 2021. They were growing in 22, and then they fell off a cliff. Half their revenue left the building. Wow, that's a lot of revenue loss. And then they started to grow again. Now, their latest quarter, it showed very nice growth, 93%. Again, that's comparing to the previous year, Q4 is here. And that was down from the previous year. So the compare was very easy because it was a low point in the company. So that's one thing to consider is Micron is now trying to get back to where it once was. It was a $30 billion company. It's still not there. It's at $25 billion. So that's what's kind of unique about this P&L, right? You're like, well, that's kind of weird that they had so much revenue leave the company in 2023. But they're back. It looks like they're back and they're profitable. Let's see here, good gross profit. They have operating income, so that looked good. The market really liked their earnings announcement. The stock really rallied, so good for them. Good for them. All right, so they're growing now, but again, I'm not like believing it's 62% growth because they had 50% loss back here, right? Okay, we're over that. From a balance sheet perspective, $8.1 billion in cash, very good. Long-term debt is 14, so very low debt. $6 billion in debt net, and I bet you if we look at EBITDA, they'll probably be able to pay that off very quickly. Yeah, they can pay it off in 9 months. Yeah, they can get rid of their debt very easily. So when we look at cash flows, how is the company cash flowing? So you saw that J&J gets treated kind of as a special company, right? Wow, man, they're really smooth, nice growth. Well, these guys, not so much. It looks like they had really good growth in free cash flow in 2021 at 2.4 billion and then 3.1 in 2022. But then again, it flew off a cliff and went down $6 billion. They burned $6 billion in 2023. And they haven't really started cranking up the free cash flow. So what's going on? Free cash flow. I cannot cash flow a company if you don't show me a decent forecast. What can I forecast for this company? It's very hard. If I average these numbers, I'd probably get to like 500 million, if anything, 700 million. So this one's a hard one. I've been asked about Micron before, and I can't give a solid answer because you see this forecast. How can I use this data set, right? What would be your guess as to what's the free cash flow you'd expect in the next 12 months, in the next 36 months? It's hard because they're not giving us like a good, smooth trajectory. J&J, 20 billion, 20 billion, 20 billion. It's like, okay, well, it's going to be 20 billion. Easy peasy. Google, we did this much, and the next year some more, and then the next year some more. They just kept stacking it. Apple, stacking it. So if they can't do that, then it's very hard to analyze. And that's why it's just a wild guess on my part. And I don't like guessing when it comes to capital, right? This one here is a pass for me because I don't have the right cash flow in front of me. And I don't know enough about the company to say, hey, their technology is superb and they're going to be double the revenue. So I'd like to get in early. Can't say that about them. And the cash flow isn't there for me. Based on earnings per share, and FYI, within semiconductor, there's lots of companies. I'm an owner of Qualcomm. I continue to buy Qualcomm shares. So it's not like it's the only semiconductor company that I could buy. And that's why I would pass is if it doesn't have the right financials, I could pass if I have 20 other options within semiconductor, which is the case. Semiconductor has a lot of good companies. Now, the earnings per share is an easier way to value a company, but it's the less desirable method for me. I'd rather have free cash flows. That's the proven way. That's what Charlie Munger used. That's what Warren Buffett uses. That's what investors, long-term investors use. And that's the proven way to really predict what a company's value is. And if you want to test that, look at the top 10 most valuable companies on the stock exchange. Look at their statement of cash flows. You're going to see consistent high free cash flows that have been growing over time. Now, when we look at this guy, that analysts say based on their earnings per share, it's discounted by a big, big margin. And that might be the case based on earnings per share. But I'm going to talk a little off color. And I'm just going to repeat what Charlie Munger once said. He said earnings per share is BS. And I'm going to keep it rated PG. He doesn't believe in earnings per share because it allows management to manipulate that number, which is true. They could influence that number quite a bit. But I still think it's a good metric that I use it. I don't take Charlie Munger's, words verbatim. But it looks like their earnings per share is good, but look what's going to happen in a couple of years. It's going to drop off the face of the earth again. So again, we're back to this data set where you're like, what do we expect out of Micron in the future? I don't know. So if I don't know, I don't invest. If it doesn't make sense, I don't invest. This is my hard-earned money I'm putting into these companies. I want my money to work at night. When I'm sleeping, getting a good night's sleep, just sleeping like a baby, I want my money to be doing crunches, push-ups, pull-ups. I want it to do strength training, and I want it to grow, and I want it to grow over time. And I need dependable companies that have good financials. We have thousands of stocks to pick from, thousands. I'd rather pick the ones that are going to be more reliable for me, the ones that I can clearly understand, and Micron's not one of them. So that's what I've got to say about Micron. I have nothing bad to say about them. I just don't. I look at the data on their financials and I can't work with it. So let's move on to CELH. Celsius. So this stock, I get asked about Celsius every week. I'm getting accustomed to taking a look at Celsius. Looks like NVIDIA just came up. Glad to talk about NVIDIA, but that's going to be next. So Celsius is an energy drink. They were doing really well, and I think one of their main competitors was playing a little chess against them and did a little checkmate on them because their competitor, I believe, Monster, formed this partnership with one of the biggest distributors of Celsius and took away big distribution from the company. What that caused is their growth rate, which was rocking and rolling. Woohoo, look at this growth rate. Isn't that beautiful? But we got to look at the quarterly, which tells you a different story. The revenue is beginning to slow down the growth rate. And they're not that big. These guys are $400 billion in the quarter. We're going to look at Monster just from a comparability standpoint. Monster Beverage, by the way, they're in Southern California. Once upon a time, they were called Hanson's Natural Beverages. I know because my mom used to get them at Trader Joe's. Bless her heart. She took good care of us. And I liked Hanson's. They had a couple of flavors that I thought tasted good. And the energy market came. They came up with a pretty good formula to compete against Red Bull. And they said, this is where the money's at. Let's rebrand the company from Hanson's to Monster. And the Hanson's brand's pretty much kind of faded because all the money's into Monster. And you can't blame them, man. This is a $50 billion outfit. They're doing $7.4 billion in revenue. They are cranking out $7.3 billion in revenue. They're a 10% growing company. So that's considerably bigger than our Celsius compare. When we look at it annual rate, this is 1.4, but that's not bad. That's not bad at all. Gross profit looks pretty good. Gross profit's pretty much about 50% gross profit. I mean, it's water with other stuff, water with a little bit of sugar, water with a couple of flavorings, a couple of food colorings, and we're good to go. Good label, get it out the door. And of course, it has to have a lot of caffeine. You can't have Monster or Celsius without a little caffeine, right? So these guys are nice and profitable. Now, again, what they were met with was that kind of move that their competitor made against them. So that's what's caused the stock price to really tumble. Now, I like stocks that, are misunderstood. This one might just be one of those, right? So it came down quite hard, down to $30 a share. It was up at $80 a share. Holy smokies. Over the last year, let's take a look at this puppy, man. This one was the pain train for stock investors. The 1 year, if you were sitting on this stock from May to now, you lost 68%. Ow. Oof, that's got to hurt. That's got to hurt. So we're talking how many months there? We're talking less than 5 months. That's brutal. Brutal. Maybe overdone. Let's see if it was overdone. Maybe this is a good stock to consider. So I think so we're at 1.5 billion. Okay. PE ratio is pretty high. It's going to get higher next year. It's a strong buy and it's discounted by 91%. All right. Let's take a look. So we looked at revenue. Revenue is still growing in the quarter at 23%. So that's pretty good. Now, when we look at the balance sheet, we have 900 million in cash. All right. So make sure we don't have a debt problem. If we have a debt problem, it really screws up good companies. They don't really have any debt. They have $1,780,000 of debt. So they don't have any debt. Very good. Nice job, Celsius. So when we look at cash flow, that's where the money is at. And see, this is better than what we were looking at with Micron. See how it's not a perfect trajectory, but you're going from 99, 123, 245. My expectations that 245 is solid. They're probably going to be a $300 million free cash flow generating company in no time. And it is a growing company. So if I go 300 million times, it's pretty good growth. So I'm going to go 25. I'm going to be at roughly about 7.5 billion, $8 billion in market cap. And they are a $7.1 billion company. So you have a pretty good little discount to work with. Now, the stock could really catch fire because this is a stock that consumers can get their heads around and start buying into the stock. This would not be a bad stock to watch and maybe nibble on because they have a good operation. They have very good profit margins. They don't pay a dividend, but at some point they will. They're establishing kind of their space in the energy drink market, right? So let me ask Meta. Meta's pretty good for this stuff. What is the market? Who are the market share leaders? Sorry. For energy drinks. And we're expecting Monster in there. We're expecting Red Bull. Let's see if Celsius is there. See what it's looking like. So Monster, okay. They have 33%. Red Bull's 44%. Yep. Okay. And the other thing that Celsius might be is a good acquisition target for Coca-Cola, Pepsi, or some other beverage company, even a alcohol company like Budweiser is no longer a company, but you get my idea, which is it might be a good acquisition target. So that's not a bad idea. I think they are, what's their industry, their consumer staple. And yeah, so beverages, non-alcoholic. Okay. This isn't a bad stock, man. I'm gonna put a little watch on Celsius because they're profitable, growing, cash flow. They were smart enough to create a new company that's going to compete against Monster and Red Bull, which is a very profitable category. I mean, I'm liking what I'm seeing. I think the market may have overreacted. And I mean, I could show you overreaction after overreaction of the market just beating up a stock and saying you're not worth very much. And pretty soon the market realizes, whoa, we sold that one off. We should come back to it. So I'm going to keep an eye on it. I don't have a lot of staple stocks, consumer staple stocks. The only one I have is Kroger, the big grocery chain. I'm happy with that investment. It's a steady Eddie. But maybe this one's a little bit more my flavor, which is, hey, catch it when it's really down. If this stock is at 30, I think it can get back to 60 quite easily, right? If it got back to 60, it's not even testing the all-time highs. Not even close. So I can double my money. Maybe just wait until it gets like 40% return, then exit the position and be happy with it. So, all right. Thanks for bringing it up. It's going to be on my watch list, and I'm going to look at it further. I like beating up stocks, analyzing a little bit more, and taking a look. But good stock to consider. All right. So everyday tech. Let's talk about NVIDIA. So NVIDIA, a company, reported their products are sold out for the next 2 years. Interesting. Okay. So I actively engage with NVIDIA stockholders and maybe NVIDIA bulls. I short NVIDIA. Okay. Let me just kind of play with my cards open. I believe that NVIDIA is an incredible company, and I believe AI is very, very interesting. But let's get into my analysis of the stock, and I would tell you why I believe NVIDIA is going to be worth $80 a share in the next 6 months. So NVIDIA was on a rocket ship ride. The rocket is beginning to run out of fuel. The rocket took off. Woohoo, rock and roll, go NVIDIA. And you know, their financials are just incredible. Just incredible. We're going to look at the financials next. But first, am I the only person that's thinking NVIDIA is overpriced? Well, let me point out a few people that have sold NVIDIA in the last 2 months, starting with their CEO. And he tends to sell the stock when it hits certain price levels. Interesting. Why the hell is the CEO selling at certain price levels? That's weird. Then Josh Brown, who's somebody who I think is pretty well put together as an investor. Guy knows his stuff. He's gotten out of NVIDIA. Jay Pulaski. Jay Pulaski has nothing but good things to say about NVIDIA. And he sold a good portion of shares. I haven't even gotten through all of my super investor, because I'm going to do a video on NVIDIA, and I'm going to explain my short position. And by the way, I'm pretty close to even on my short position after opening it in May. And my next point that I'll make is, so a lot of super investors are selling it. So that should be concerning, like to a stockholder, like, wait, why are all these really smart investors who have made billions selling the stock? Okay. Not only Jensen is selling the stock, but all these super investors. If they thought the stock was going to keep working, why not keep it? Why not hold it? Okay. All right. The stock hit its all-time high June 18th. And this is where, man, I wish I had Trader Prad's intelligence for the next 5 minutes, but I don't. So I'm going to try my best. So from there, the next high was lower. Oh, man, I hate when my mouse does that. I got this new mouse and it's got too many tricks. The next high was 0.5% lower. Okay. And then from that high, it went even lower. So the highs are following a lower trajectory. And then the next high, lower. Now it's down. Well, is it going to come down even more? And then the next high is going to be even lower and lower and lower and lower. And at some point, okay, so I'm not imagining things, right? So the stock is back to even to where it was as far back as May 29th. That's when I started shorting the stock. Woohoo, man. Crazy that, I mean, I've gotten more excitement from holding this short position. I got my money's worth because it went up, it went down, it went up, it went down, it went up. I went on Reddit and posted my analysis. Man, I was like targeted. I thought I was like, man, it was kind of fun though. It was nice to converse with people. And frankly, some really intelligent people are in NVIDIA. They really were asking revealing questions. They really were testing my analysis. And frankly, some of my analysis could have been better. But at the end of the day, I loved it. And man, I hope who asked the question? Everyday Tech. So everything we're talking about here, I'm going to start with and end with. NVIDIA is a great, great company. Intelligent people. They nailed GPUs. I'm a GPU customer. I bought GPUs for my son when he was mining Bitcoin 6-7 years ago, maybe 8 to this point. And time flies when you get older, by the way. Just note that. You'll see. When you get to my age, you'll be like, wow, man, time flies. So I'm a big fan. I used to be a stockholder. But let's take a look at their financials now and see what is revealing there. And I did, and I don't have it readily available, but if you watch the last video I did on NVIDIA, I'm going to explain what I showed. And I may not be able to show it here because I can't just off the cuff show you a sequential growth projection. I'd have to go dig it out of my drive, and I don't want to bore you guys with that. But I will bring it up on the next video I create. I'm going to create one in the next 4 or 5 days. I'm probably going to wait till the weekend and do my NVIDIA update and share that trajectory or that growth trend that I'm seeing. So when we look at financials, right? When you look at growth companies, this looks sensational, stupendous, incredible. Okay. Those are the right words. And then we look at quarterly. Okay. Now, the reason why these numbers are incredible is you had a low compare. You see these compares like Q4 of 23 compared to Q4 of 24. You're going from 6 billion to 22 billion. So boom, big jump up. Applause. Great job, NVIDIA. You are awesome. But the compares are getting harder. And I did this projection on a spreadsheet. I'll update it when I do my video. And the growth is coming down to like 20%, teens. At some point, it's going to stop growing. When it stops growing, I think investors are going to freak out because, hey, I'm paying for a growth stock. I'm paying for a growth stock. Why am I not holding a growth stock? And I'm hearing, I think people that want to support this stock, which I understand. Apple is the same case. People really support the Apple stock. I have nothing against Apple. I have nothing against NVIDIA. But pretty soon it starts looking like any other tech company. But there's thing that we got to remind ourselves is semiconductor is cyclical. Some people believe, I'm not in that camp, that AI is special. The AI build out will go on forever. And I don't believe that. I think if that was the case, a lot of companies will go bankrupt because the CapEx that you have to lay out for AI. Now, Meta is a very wealthy customer, but they're done. Meta AI is stupendous. It's awesome. I don't think they have to buy many GPUs anymore. You have like Google, they develop their own technologies. In fact, AI for Apple, some of the projects they're creating, they're doing it on the Google technology. So where's the demand going to come from? After you get through the first wave of really wealthy customers that really are truly building AI. Some people jump 20 years into the future and say, well, AI is going to be in healthcare and it's going to be in this and it's going to be in that. And I'll point something out really, really, I think applicable is we have a labor strike on the East Coast and on the Gulf of Mexico. And the longshoremen, the people who are the labor to unload these ships, their main contention is the ports are automating, and we will strike and force them not to automate because you're taking jobs away from us. That's the headwind against automation. Now, I have a brother-in-law that works at the LA ports, and he's told me about the automation they have with one port. It's incredible. It's been there for like 10 years. It's not new. So AI, people think that it came out last week or 2 years ago. No, it's been around for like 10 years. We've had chatbots for 10 years. Siri on your iPhone, that's been around for 10 years. That's AI. So, but it didn't take off. People got bored of it. It's like, whatever, I don't want to use it anymore. Or Alexa from Amazon. They poured billions into those projects. It didn't go anywhere. So that's why Apple was kind of gun shy about putting money into AI. They're like, we tried that. It was a freaking failure. Nobody uses it anymore. We don't want to dump money into a hole and burn it. So the strike from the labor on the ports is an example of, if you think AI is going to replace large numbers of people's, there's going to be a lot of pushback from politicians, from labor leaders, from employees. It's going to be like, wait a second. I understand for some jobs, yeah, we don't want, humans to do those jobs. Maybe the jobs are hazardous or something like that. Okay, use it for those. Or something that a human can't do. Yeah, use it for that. But the use cases are not abundant. Some real use cases. I'm really impressed with Meta AI. Meta AI is probably my favorite tool. I've used ChatGPT. I've used Gemini. I've used Copilot. I think they're really good tools, but they're not like changing my life. They're not yet. So I think NVIDIA, the next 12 months are going to be super interesting. And I encourage you to keep coming back, Everyday Tech. And when I'm wrong, I will admit to it. I will eat a nice plate of crow and I'll say, this is where I was wrong. I've been wrong before. I've done videos citing that. I have to be right 7 out of 10 times to make a lot of money. I will be wrong. I'm not going to be stupid enough to think that I'm not going to be wrong once in a while. But so far, I'm not wrong yet. Okay. And I don't know that anybody's going to argue with me. I picked a pretty good moment. I saw a thesis that, hey, everybody was on the other side of the boat at this time. Like, people laughed at me, and that's cool. And now people are like really engaging with me on Reddit going, okay, tell me again how I came to that forecast, because I think it's making more sense now. And again, we'll follow it. That's been a super interesting stock. It's been an absolute worth the admission price. Right now I'm even, so I haven't paid any losses. But as I say on those videos, is either the market's going to teach me a lesson that I have to pay a price for, and maybe I lose 30% and I pay a price for a lesson, or I make money and I teach myself a lesson, which is, okay, do your analysis, think about a stock, if it's going to go up or down. The market's expensive, and it's easier to find stocks that are overpriced right now than it is to find stocks that are gravely discounted. Like Celsius looks pretty good. So that's my story on NVIDIA. So Brad. So I would probably cash out at $85 a share and just, okay, cool, done. See ya. Or maybe 90, I don't know, but I'm far away from that, man. I'm not going to, it's like the football game is starting and people are asking me, hey, in the fourth quarter, would you rather score a touchdown to win or a field goal to win? Look, man, let me get through the first quarter without, giving up any points and trying to score a few points on our side and move the ball down the field. I'm going to keep a close eye on NVIDIA. It's been really interesting to see the semiconductor company industry move. One big story that's taking off, right, is China. China's been super dead for 3 years. These are quality companies in a faster growing economy than the US. And the market said, I just think that China stocks ought to go down, like Alibaba. I don't care if you're growing. I don't care if you're profitable. I don't care if Charlie Munger thinks you're really cool and he nailed Costco early. He nailed a bunch of stocks early. He just felt very, very confident in Baba, and it discounted Baba by 80%. This is what the market's done to China over 3 years. And now China's beginning to go. They can go and double in value and still not even get back to a third of its previous value. It could triple and it's still not getting to like 60% of the previous value. Meanwhile, you have, stock market in the US, I'll compare it to the NASDAQ, which is very comparable. It's been rocking and rolling. It's been going up, and you compare the two and it's like, this is the opportunity in China, is China needs to correct closer to where that NASDAQ is. And as I value stocks, I did a video today. The fundamentals are just so different than US stocks. You're seeing fundamentals that are 3 times better in China. And they're going to grow at 5%. US is going to grow at 2%, 2 versus 5. They're going to grow at 5% for 3 consecutive years. We're going to grow at 2% GDP for 3 consecutive years. Their government's going to prop up their economy by stimulating it. That's going to help their companies, and their population is growing their middle class really fast because China 100 years ago was agrarian. It really didn't have a very big economic engine. Now they do. I don't think anybody doubts that. So Brad, you bought PDD, it dropped. Yeah, man, you're telling me. I began to lose faith in Alibaba, and you guys that were on a stream a month or 3 weeks ago, Mercado Libre has been like doing really well. And I'm like, man, I should get rid of my Alibaba stock and switch over to Mercado Libre. And I didn't, because Mercado Libre's price is a little expensive. And now I'm like, oh, I bought, for the first time today, I bought Baidu, and I bought NTES, NetEase. I already own Baba, and I'm buying a ETF. So I dropped like $550 on Baba, $1,000 on Baidu, $1,000 on NTES, and $1,000 on FLCH, which is the ETF that I prefer. This is a lower expense ratio than the FXI, and I'm up to $3,000 or $2,000 on this guy. But it's a little uncomfortable to buy into an appreciating market. But look at these graphs, man. This is an ETF. These guys own like Tencent, Baba, and they own a bunch of different stocks. And look at the trajectory of this puppy. But now look at it over the 5-year. It's not even close to getting back to a third of its value. When it gets to half of its value, it will more than double. It's awesome, man. Hoo-hoo, rock and roll. You got JD, atta boy. I did a video on JD about a week ago. It's a really good stock. The reason I didn't buy JD is because JD resembles Alibaba quite a bit, and I wanted to kind of diversify a little bit. So that's why I got Baidu and NTES. And then I do own JD through my ETF. So, but who knows? Maybe I'll buy some JD too. We'll see where that goes. All right, everybody. Let's call it a stream. I want to get off the airwaves because I want to go listen to my man Prad at 8 p.m. Eastern and listen to what kind of trades he had going on. Everybody, thanks for tuning in, and do me a giant favor and consider being a paid member. I want to make this a community that everybody's going to love and appreciate, and I'm investing in the channel. Some of you are already members, and I want to thank you. It really means a lot for you to be a member. Take a look at the details in the chat. The video. Consider being a member, and you'll see what the market today. Some benefits. Use tool set of the tools that I use, as well as when you attend the streams, your name gets highlighted a different way. And then there's an investor call. And I hope that current members can attest that, I go out of my way to make this a valuable community. And that's what I want to do. I've been an investor for more than 30 years, have been successful at it. I feel like I've kind of gotten to a really good point where I'm making money substantially. And I like sharing it because 20 years ago, people were sharing it with me, and a lot of people helped me out, and it's good to pay back. It's good to show other people, maybe some ways of investing. And if the community grows, that means more people, I get to help more people. So that'll be really cool. So everybody, thanks for attending. I really appreciate you. Everybody have a good night. Take care. I will see you tomorrow.